So what's the single biggest risk an auditor faces? I'll give you a hint. It's not about finding a typo. It's the risk of getting the entire audit wrong. In this explainer, we're going to unpack what's known as audit risk, which is really the central challenge of the profession and the clever framework auditors use to manage it.
Before we jump into any fancy formulas, let's talk about the stakes here. Because when an audit goes wrong, the consequences are, well, they're massive. We're not talking about a simple math error. The absolute nightmare scenario for any auditor is giving a clean bill of health to a company's financials when, in reality, they're filled with major problems. That is the very definition of audit risk.
And it's so important to separate the company's risk from the auditor's risk. You see, a company worries about things like their hot new product becoming obsolete or a fire at the factory. That's all business risk. But the auditor, they have a totally different fear, signing off on the financial statements and being catastrophically wrong. The fallout from that isn't just a bad day at the office. We're talking about lawsuits and career-ending damage.
So, here's our game plan. We'll start with the auditor's blueprint, the model they work from. Then we'll dig into the client's risk profile, see how the auditor responds to that, and finally, we'll put it all together to see how the whole thing works in practice.
Okay, so how do auditors deal with all this uncertainty? Well, they don't just rely on a gut feeling. They use a structured, really powerful model to assess and manage the risk of getting it all wrong. And here it is. This might look like a simple formula, but trust me, it's the foundation of all modern risk-based auditing. It says that the overall audit risk is a product of three main things: inherent risk, control risk, and detection risk. So let's unpack what each of these really means.
Right, those first two parts of the formula, inherent and control risk, they're all about the client's world. This is the situation the auditor walks into. And here's the key thing to remember. The auditor can't change these risks, but they absolutely positively have to understand them inside and out.
First up is inherent risk. You can think of this as the raw baseline level of riskiness that exists before you even think about any of the company's safety nets or controls. Some accounts or transactions are just naturally more likely to have problems. It's the risk that's just, well, it's inherent. An inherent risk can pop up from all sorts of places. For instance, if you're a tech company, that warehouse full of last year's smartphones is inherently risky. It could become worthless overnight. That risk is tied to the nature of the industry. Or imagine trying to value a new, complex financial instrument. It requires a ton of subjective judgment, which makes it inherently risky. Even something good, like rapid growth, can create chaos and introduce new errors. Okay, next up is control risk. So if inherent risk is the problem, then internal controls are supposed to be the company's first line of defense. Control risk, then, is the danger that those defenses, those internal safety nets, are going to fail. It's the risk that their own processes just won't catch an error when they're supposed to. What does this look like in the real world? Well, a classic example is if one single person can both approve a payment and then make that same payment. That's a huge control risk because there's no oversight. Or maybe no one bothers to check if the company's records actually match the bank statements. Errors could just sit there for months, undetected. When these controls are weak, the door is wide open for big misstatements.
All right, so the auditor has assessed the client's inherent risk and their control risk. But remember, they can't change those things. This brings us to the final piece of the puzzle, and from the auditor's point of view, it's the most important one. It's the one component they can actually control. This slide just sums it up perfectly. On one side, the auditor is like a detective, assessing the client's risk landscape. But on the other side, they become the pilot, actively controlling their own risk, detection risk, by adjusting how they fly the plane, so to speak.
And that third piece is called detection risk. Put simply, it's the risk that the auditor's own work, their tests, their procedures, everything they do, will fail to detect a material error that has already slipped through the client's shaky controls. It's the risk that the audit itself fails to find the problem.
But we can actually get even more specific here. You see, detection risk isn't just one big blob of uncertainty. It really breaks down into two distinct ways an auditor might miss something.
So here are the two ways an audit test can go wrong. First, you've got sampling risk. Auditors can't check every single transaction, right? So they test a sample. But what if, just by dumb luck, the sample they picked looks perfect, but all the big errors are hiding in the invoices they didn't check? That's sampling risk. Then you have non-sampling risk. This is basically every other kind of human error, using the wrong audit procedure, misinterpreting the results, or just plain failing to spot an obvious error.
Okay, so let's put all the pieces together. How do these three components, inherent, control, and detection risk all interact to build a complete audit strategy. This is basically the auditor's playbook for high-risk situations. If they walk into a client where the inherent and control risks are through the roof, they have to compensate. To keep their overall audit risk low, they must drive their own detection risk down. And how do they do that? Well, they bring in their A-team, their most experienced staff. They do more work. Maybe they test 500 items instead of just 50. And they crank up their professional skepticism, questioning absolutely everything.
This flow here shows that inverse relationship perfectly. Just follow along. The auditor assesses the client's risk and, it's high. But the audit firm's standard for overall audit risk is always low. So to balance the equation, the auditor has no choice but to force their detection risk to be very low. And that decision has a direct impact on the audit plan. It means more work, more testing, and a more intense audit. It's a simple rule. The higher the client's risk, the more work the auditor has to do.
So at the end of the day, this audit risk model is an incredibly powerful tool. But it's not some magic algorithm you can just plug numbers into. At every single stage, from judging a client's risk to designing the actual audit tests, it all comes down to the auditor's professional judgment, their experience, and their skepticism. That's what really turns this formula into a crucial safeguard for all of our financial markets.